Leads us to our talk of the tape. Is the risk reward improving for stocks or getting worse? And what, if anything, can get us out of this stubborn trading range? Let's ask Courtney Garcia of Payne Capital and a CNBC contributor. She is here with me at Post 9. Good to see you again. I mean, it's like, what are we ever going to get out of this range?
That's what we're hoping for, right? I mean, clearly, I think what's happening right now with the debt ceiling is not an issue. The markets are really barely reacting to that. I think everybody's expecting there's not going to be any sort of they're not even calling this a negotiation, which I think is probably a sign that nothing is going to get done right
we
now.
Can't even get to the point of where we're having a negotiation.
Exactly.
That pretty much says it all about where we are.
Yeah, unfortunately. So I think this is going to be a problem for later this month. It's going to go down to the wire. I think right now what's more important is CPI, which comes out tomorrow. And that's really been the big story all year is inflation coming down, which it does seem to be coming down, which is great. The Fed is likely to be pausing with interest rates as we move forward. We're still have a really strong labor market. I mean, all of these things I think are actually leading to really positives if you look forward. But yes, we do need that catalyst moving forward. But I think you're going to need some more data points that inflation's coming down and labor's still on good footing for people to start to get over these recession worries.
You know how, the market, generally speaking, has tunnel vision, they say, right? It's like right in front of it. That's the only thing it pays any attention to. But do you think there's some level of complacency around the debt ceiling fight? I mean, the VIX is at 17.5, and the market's been so resilient. It's not in any way reacting except for a very small part of the yield curve.
Well, keep in mind, I mean, I think a lot of people are looking back to 2011, where we did have a pretty severe reaction to stock markets. They were down about 17% when we got close to that debt ceiling limit at that point in time. But realistically, there's been about 45 increases in the debt ceiling in the last 40 years. So this happens very often, and it almost always gets done. I think that's what a lot of people are realizing. But it is an election year. This is going to be thrown around like a political football. I don't think anybody expects this to be done today, and so I think that's why you're seeing that in the markets.
So how do you assess where we are after a pretty big week last week, where the Fed hiked again? They didn't explicitly say they're done, but the market assumes they are. Yep. Not only that, the market still assumes that there are going to be cuts this year.
Yeah, which I'm not necessarily the mindset that there's going to be cuts this year. I do think we're probably going to stay at this higher for a longer level. But the idea that there are going to be cuts later this year, I think, is also pricing in the idea that people are expecting inflation is going to continue to come down this year, which is ultimately going to be a good thing. And I think realistically, we've gotten to this place where even the Fed is surprised at how they've raised interest rates by 5% over the last year. And we're still at a 3.5% inflation rate. Unemployment rate. So things are actually in a really good position. And now they're in a position that even if we go into a weakened economy, they're at a higher rates where they can bring rates back down to boost things if they need to. And realistically, what you're seeing with companies' earnings is they are prepping for the recession that hasn't even happened yet, which is why I think even if a recession happens, it's probably going to be a lot more muted at this point.